Hi friends, Simit here from informedtrades.com. In this video I want to take a look at Paul Tudor Jones, legendary trader. Paul Tudor Jones was featured in Jack Schwager's book Market Wizards, which we've talked about a lot on informedtrades.com. Paul Tudor Jones basically got his start as a trading assistant. He says he was basically like a secretary to a trader, worked his way up from there, and is now a billionaire managing his own hedge fund. Has been a very successful trader, quite acclaimed in his own right. We'll take a look at his approach in this video. Some key points about him. Paul Tudor Jones is a swing trader, so he's focused on finding swing highs and swing lows. That's sort of a form of calling tops and bottoms. Paul Tudor Jones says he'll actually miss the bulk of the move, but he finds it much easier to catch those extreme points and profit, earn a small profit that way. Like many traders, though, defense is the key. Money management is the name of the game. Paul Tudor Jones definitely abides by a strict money management protocol. Even though he is in many ways a short-term trader, or at least he was back in the 80s, his current approach is a little unclear, as he grants much fewer interviews now. But at least back in the 80s, he used Elliott Wave to identify major cycles. Even though he was trading short-term, he did keep an eye on these big cycles. And in terms of fundamentals, his view is sort of that debt drives the global economy. That sort of helps him develop a macro view that he can trade against. Focus on finding swing points. On the chart right now is sort of an example of a swing low. This is a very clear low. You can see the price spikes down here. It's a moment of extreme price movement. That's kind of the opportunity that Paul Tudor Jones like to focus on a lot. Catch that moment when the market is at an extreme of sorts, get a small profit. He often said he'll miss the bulk of the trend. He might miss the meat of this move from this swing low all the way up here. But catching that reversal once the market reaches an extreme is an opportunity that he focused on in his active trading. Good defense is the key. Paul Tudor Jones says he keeps mental stops, or he kept mental stops. When you're trading a large amount of money like he has been, sometimes placing an actual stop loss order is a bit of a problematic and tip your hand. So he kept a mental stop loss order. Again, he was very into the psychology. He accepted losing as part of the game. He didn't dwell on it, shrugged it off, kept the losses small, accepted them, and moved on to his next opportunity. He also was very into monitoring correlations between markets, and this was a way of mitigating risk, putting on positions in trades that aren't correlated as a way of diversifying his funds, mitigating risk that way. Short-term trades based on long-term cycles. For instance, 1987, the crash in 1987 was a real great opportunity for Paul Tudor Jones. He foresaw that and profited immensely from the crash in October of '87. One of the things that enabled to see that a crash was coming was he was watching the parallels in the market from in the late 80s as well as in the late 20s. So this illustrates the kind of cycle analysis that Paul Tudor Jones used. And through this type of cycle analysis, he could see the parallels that were coming. He foresaw a depression of sorts, a market crash of sorts that paralleled what was experienced in the late 20s, and began positioning himself accordingly for that. Another thing, that's sort of examining the history of price movement, is sort of the technical component. In terms of the fundamentals, he also saw or monitors debt. He has the view that debt cycles drive the global economy. Accumulation of debt relates to or is correlated to a booming environment, and then when a debt peak has been reached of sorts and it comes time to pay down the debt, that's when markets tend to consolidate and bear markets enter. So here, in the 20s, again, we saw a big accumulation of debt, followed by the spike, leads to now it's time to start paying off the debt, which is going to lead to, or in the 20s, that led to the Great Depression in the 30s. He sort of draw that parallel in the 80s. There was a big accumulation of debt during a lot of deficit spending in the 80s, and that's what enabled him to see the crash coming in 1987. Here's a short video of Paul Tudor Jones talking about debt and how it relates to the global economy.